Welcome to Profit Insights, the podcast where we unravel today's top financial stories and market dynamics. I'm your host, Dusty, guiding you through the economic maze with calm and clarity. Today, we're diving into the significant developments as of Monday, June 23, 2025. Let's start with the market overview. Stock futures are pointing toward a modestly lower open, influenced by weekend events that saw U.S. airstrikes on Iranian nuclear facilities, intensifying the already tense situation in the Middle East. This raises fears about Iran's potential countermeasures, such as closing the Strait of Hormuz, a move that could significantly disrupt global oil supplies. The situation has given the U.S. dollar a boost, benefiting from its typical safe haven demand. Meanwhile, oil prices have surged, although they've pared back some of the more intense gains as the market weighs the risk of potential supply disruptions. Brent crude opened higher, reflecting concerns over these geopolitical tensions. On the global stage, business morale is a mixed bag. Flash PMI surveys will be crucial in the coming days, providing insights into how these rising tensions and ongoing tariff uncertainties are impacting confidence. Turning to the stock market, U.S. equities show resilience as the S&P 500 and Nasdaq flirt with near all-time highs, bouncing back robustly from previous lows in April. But the fresh geopolitical strife has set a cautious tone for today's opening. The semiconductor stocks continue to bolster the industrial and technology sectors, driving much of this rally. Despite this growth, last week's shorter trading session ended with the S&P 500 slightly down by 0.2%. Amid speculation of conflict escalation. Now onto economic indicators and central banks. Bond yields have dropped, with the 10-year Treasury yield at 4.36%. The Fed is holding rates steady for now, projecting a couple of rate cuts by the end of the year, despite downgrading growth forecasts and elevating inflation expectations. Across the Atlantic, the Eurozone Services PMI held steady, a tentative sign of stability amidst uncertainty. In Japan, the Bank of Japan's dovish signals have led to a weaker yen against the strengthening dollar. Economic data reveals softened U.S. retail sales, industrial output, and housing, hinting at potential challenges ahead, not forgetting the strains from rising import prices and cumulative tariff tensions. S&P Global reports an increased inflationary pressure in Canada, directly tied to tariffs, and we're anticipating inflation data from France and Spain that could influence this week's outlook. Let's discuss valuations and the broader outlook. With the S&P 500's forward price-to-earnings ratio at an elevated level, just over 21 times earnings, we're trading above historical averages. Economic headwinds from geopolitical risks and trade tensions may slow down global growth. The Federal Open Market Committee's toned-down growth forecast and increased inflation concerns have already put downward pressure on equities. In the commodities realm, gold hovers near its all-time highs. Showing slight volatility, oil persists as a focal point, with premiums soaring amid worries over potential Iranian retaliations. This week is loaded with pivotal events. Fed Chair Jerome Powell's testimony, key inflation reports, and GDP figures from the U.S., alongside crucial PMI data worldwide. These could drive market sentiments and offer more signals about where we're heading. So, in light of these swirling dynamics, here are a few investment tips. Adaptability remains crucial. Align your strategies with both the optimism from central bank stability and the caution necessitated by geopolitical turbulence. Diversifying your portfolio, especially in energy sectors like oil and safer investments, could shield against sudden shifts. That's it for today's episode of Profit Insights. Thanks for tuning in. Remember, when the dust settles, only the truth remains. Stay informed and approach the markets with a balanced view. Until next time, take care and be wise with your investments.